Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets so you can make actionable investment steps. I'm Jake Ackerman. Today is going to be solely about the Fed meeting that took place Wednesday, where the Fed decided not to hike interest rates. We're going to listen to what Fed Chief Jerome Powell said, and then we're going to interpret between the lines and find out and talk about exactly what he meant. So let's get started. I'm going to put this first clip on your screen here. Check it out.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
Right off the bat, he talks about the dual mandate that the Federal Reserve has. They have, number one, price stability. Inflation expectations and their projections, where they want inflation to be at is at 2% annually. That means prices raise at a 2% rate. Right now, we're at a 3% rate. Previously, we were nearly a 9% rate. So we're on our way down from that 9% to 3%, but we're not quite to that 2% rate where the Fed wants it to be. So right now, prices are still rising higher than the Fed wants. Their second mandate, and that's maximum employment. Maximum employment means they want to keep the unemployment rate as low as they possibly can. They want people at work, and they want to maintain that level for as long as they possibly can. This year we had historic unemployment. However, unemployment has been slowly ticking up as the ramifications from the Fed rate hikes are being felt. And I want to point out during that clip one thing that he highlights, and that's price stability. Price stability, price stability. Without price stability, we can't have maximum employment. Prices need to be stable, or consumers can't purchase the goods. If consumers can't purchase goods, business can't profit, and their business can't hire people and pay employees. So it's a ripple effect. The prices aren't stable. Prices need to be stable. And that's something that Fed Chief Jerome Powell highlighted in the first point of his press conference. Let's move on to that second clip.
We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
What did he say there? They've been tightening monetary policy, but the full ramifications from their tight monetary policy have not been felt. We're still in the first phase of this ramification phase. We're just starting to see it in the data. We're just starting to see that unemployment rate tick up. We're starting to see consumers' expenditures, yes, they're high, they're continuing to be high, but now it's shifting from savings and it's going to credit cards. So they're well aware that their tight monetary policies has a delayed effect sometime in the future, and we're starting to feel it, again, early phases. Let's move on to this next clip.
Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment.
I find this one interesting. So, in the previous clip, you heard him say that the full ramifications of the rate hikes have not fully been felt. And in this clip, he says the consumer is still strong, economy's still doing good. Yeah, the housing market's slowing down, business expenses or business expenditures are slowing down, but the economy's still strong. And there's a reason he has to say that. He can't say that it's coming into the future. No, they have to keep rates as high as they possibly can because price stability is the most important thing. So they're willing to give up job losses to keep prices stable and to bring down inflation. And they're using the good numbers still as their reasoning for keeping rates where they are and possibly having another rate hike in this meeting coming up here, end of October, 1st of November, or possibly into December. So they're using this good data, and again, because they have to. If they take their foot off the gas pedal and inflation goes back up, then they're in this fight all over again. And the ramifications from another fight, it is a long, long period of time of no economic growth and more pain for people that are on fixed income and business expansion and innovation. Let's move on to this next clip.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
Again, in this clip, he did this several times throughout this press conference, highlighting the most important mandate that they have. Remember, 2 mandates: maximum employment, price stability. Price stability means bringing inflation down, keeping interest rates high as long as they possibly can. And that's what they're going to do. They're telling us they're going to keep interest rates high for as long as they can. And how long do they keep interest rate high? We could take a look at history and we can see they keep interest rates high until things start to break. And that's what they plan because they have to do it. So we deal with short-term pain, and that's what they're willing to accept. And one thing I want to point out too is these Fed officials have a legacy to maintain. A legacy of a Fed official means they did the hard things that were not politically good at the time, but they turned out to be the right thing for the society as a whole. Take Paul Volcker, for example. He hiked interest rates basically overnight to 20%, bringing our economy to a screeching halt and putting us into a recession during that time that was very politically tough. He took a lot of blowback, but he did the right things, and now he maintains a legacy of being a brave man and doing the right things during a very difficult time. And the Feds want that, and they understand that, and that's why Fed Chief Jerome Powell brings Paul Volcker to his meetings all the time and talks about him. He respects the man because he did tough things. All right, let's move on to this last clip here.
Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
They're acknowledging that their interest rates are having an effect. They're not going to raise rates at the same pace that they did in 2022 because there's no need for that. However, their number one goal, and we said it throughout this entire video, Jerome Powell said it throughout his entire press conference, is price stability. They're going to defeat inflation. They're going to do everything in their power to do that. And it may mean one more rate hike because of a few things. Energy prices have been climbing back up for the last month and a half. And energy prices are one of those volatile indicators, food and energy, that the Fed really doesn't look at. But I can tell you what, energy prices are felt throughout all of society. Your transportation, your manufacturing, your building material, anything with petroleum, which is a lot of products, are going to be felt by higher crude oil prices. So the Fed is keenly aware of that. And if we start to see a tick up of an inflation print over these next couple months leading towards the end of the year, we're going to get that last rate hike. And also, businesses are hiring for the holidays, expecting consumers to spend, which I don't think they're going to spend like they're planning on or expecting them to spend. But that might also give people a pay increase, bring down unemployment for a little bit longer. So we have a window here to see how things play out, maybe get one more rate hike. If not, I would expect rates to maintain exactly where they're at until, unfortunately, things start breaking. But we'll keep you updated on that. If you got some value from this video, do me a favor, like and subscribe. Tune in next week. We'll talk about an inflation data report that's going to be released late next week. Stick with us. Expertise you deserve. Experience you can count on.